Good evening, everybody, and welcome to our final spring 2021 virtual executive speaker event. My name is Dr. Nicole Coppell, and I'm the MBA director. Many of you know for the past year, we have been offering this virtual executive speaker series, and we have been thrilled by the participation, interest, and easy accessibility of these online events. This is just another example of a silver lining from this pandemic. We've also been able to attract interesting, relevant, and timely executive speakers to present to us in this format, and we have been able to include so many members of our Montclair State University community in our audience, including our MBA and undergraduate students, other graduate students, prospective students, alumni, faculty, staff, and several representatives from the school's advisory board. The format of this evening session will be a presentation by Jack Peterson, co-founder and managing partner for Summit Trails, followed by a Q&A session facilitated by our own Dr. Ron Strauss, the department chairperson for the Accounting and Finance Department and the incoming Senior Associate Dean for the Feliciano School of Business. Thank you to everyone who provided questions for Mr. Petersen in advance, and we invite you to enter additional questions using the Q&A feature found on the bottom of your Zoom screen. We will do our best to have him answer as many of the questions as time permits. Once again, this has been a team effort on behalf of our MBA and graduate program staff, Dean's Office, development officers, alumni relations, and the FS Bus technical team. I want to thank everyone for their contributions. At this point, I have the honor of introducing Jim Murley, executive in residence and advisory board member for the Feliciano School of Business and a huge supporter of MBA and graduate programs, who will be introducing our featured guests. Thank you, Jim.
Thank you, Nicole. I'm very happy to be able to introduce a former colleague and friend of mine, Jack Peterson. As Nicole mentioned, Jack has had a long and distinguished career in finance. We worked together for a number of years at both Lehman and as well as Barclays. Jack is a graduate of the University of Minnesota, Golden Gopher, the Tuck School MBA program of Dartmouth, and he worked at Morgan Stanley for a number of years before joining Lehman in a senior management role around the wealth management business. A number of years ago, after spending some years at Barclays, Jack and a handful of his colleagues decided to go out on their own and start their own RIA firm, registered investment advisor, called Summit Trails. And in a relatively short period of time, over, I guess, the last 5-6 years, Summit Trails has grown to now over 12 billion in assets under management, with more than 75 employees across the country in 6 offices, serving over 400 clients. So with that, I'm going to turn it over to Jack and let him talk a bit about the industry, his background, and then invite you to ask some questions. So thank you very much. And Jack, over to you.
Great. Thank you, Jim. Great to be with everybody tonight. We're going to take probably 45 minutes or so, and I've got some prepared slides. I'm not a big fan of slides, but it'll help me kind of stay on track time-wise, and it will give you a little bit of data to work with and process as we proceed. So we've got the Red Hawk. I did not want to think about what a Red Hawk would do to my gopher back in Minnesota, so we're going to get off the title page here quickly. So here, real quick agenda. I'll just spend a couple minutes on my background and then get right into the important topics. But to spend a little bit of time on the financial services industry as a whole. There's a lot in our industry. I absolutely love our industry, a ton of opportunities for all of you. It's been very good to me over the last 28, 29 years. And then I'm going to dive from big picture financial services down into wealth management. And that's where I've spent my time in this industry. And then we'll spend a little bit of time on investment themes. I've got one slide to give you sort of a day in the life of what I go through as a financial advisor. And then I've got a number of slides on market outlook. I don't know how many of those we'll get to, but I wanted to give you all sort of a feel for the work we do at Summit Trail to benefit our clients. And then Q&A. I'm happy to go through any questions you would like. We can go back in the slides if you want to reference something. And then if we don't get through everything tonight, a number of you have already reached out on LinkedIn, which is great. I'm happy to connect, and we can, continue these types of conversations offline. So financial services, it's a massive industry. I think for most people, it's not nearly as well understood as it could be. I think for all of you, especially the MBAs, first and second years, I think this industry offers massive opportunities, and for a lot of different people. You don't necessarily have to be a super quant or Excel nut to really do well in this industry. I've broken it down into three primary categories. In the middle, I think of, and from a client perspective, institutional clients. This is investment banking and commercial banking. And again, I'm going to hit these quickly. We can do more time and detail later on. But mergers and acquisitions, corporate finance, sales and trading, prime brokerage. This is the primary suite of services that investment banks provide institutions, corporations, pension funds, or not pension funds, other entities that are dealing with running corporations. Commercial banking, same thing, but it really tends to focus on cash, lending, and deposits and custody. Those two primary businesses, investment banks, commercial banks, serve institutional clients. On the right of the screen here, thinking about the retail client, again, you've got many of the same banks. You've got broker dealers, trust companies, a number of direct organizations like a Fidelity or a Schwab. And you have this new, relatively new and emerging channel or business model called RIAs, Registered Investment Advisors, also referred to as independent firms. I'll get back to those in a minute. But this group of institutions are serving retail clients, very different from the middle two types of banks. Far left, asset management. Again, this is a very large part of our industry. I think of asset management as really the manufacturing of investment products, whereas the banks in the middle and all the retail service organizations on the right side are providing primarily services and advice. The far left group here under asset management, they're actually creating products. So traditional long only, this would be equity managers, fixed income managers. It was kind of the beginnings of asset management. Hedge funds started in the 50s and the 70s, those being long short investment strategies. You're all familiar with private equity and venture capital right now. Real estate, commodities, the asset classes, there's a long, long list. I also think of insurance as really part of the asset management group. And then I just allow myself the convenience of a specialty other bucket where everything I've forgotten can kind of neatly fall there. But these companies, these people, these professionals are creating mutual funds, separately managed accounts, hedge funds, limited partnerships, insurance products that are built for both institutional as well as retail clients. And again, when you think about coming out of business school, you're looking for a job, there is a vast array of opportunities across these three different categories. And I tell everybody, and I really believe this, don't get too hung up on your first job. If you think you like finance or the markets, or you like working with clients, we're going to talk a little bit more about that in a minute. That's great. Just get a job, get into the industry. I think one of the really neat things about financial services is it's a relatively small industry. You can get from one firm to another, or within your firm, you can move from one division to another, from one role to another. provided you're, working hard and doing well. So we'll come back to this in a moment as we get into wealth management. But my key point here is massive industry, a ton of opportunities for a lot of different types of people. So if we look at the previous page, we come here. I found a way today to create my own Venn diagram in PowerPoint. I really tested myself. And the key part here is really where all three circles intersect. This really dark triangle in the middle. And this is really where wealth management sits. I think most people don't have a great appreciation for this. But I'll tell you a very brief story. I'm in my second year at business school, and we're all interviewing, and all my classmates are going to work for investment banks and consulting firms. And I had worked for IBM before business school. I loved marketing. I didn't love computers. I ended up interviewing with Morgan Stanley, Goldman Sachs for a very small group, which at the time back in the early 90s was called Private Client Services. I ended up getting a job with Morgan Stanley. I was really excited about it. As I told my classmates, they all said, "Jack, you came to business school to be a stockbroker?" I'm like, no, I'm not a stockbroker. It's more than that. And even I had a lot to learn about wealth management. So when you look at this Venn diagram here, wealth management as a financial advisor, it's really one of the very few roles in the financial services industry where we are cross-trained and expected to be able to speak to any type of client, institutional or retail. And we're also expected to be able to really be conversational and value added across the previous page here. So as I talk to my clients, I have to be able to talk about M&A. I have to be able to talk about venture capital. I have to talk about the services provided by a trust company. And so you're really required to know quite a bit about each one of these different areas. And for me, that's very interesting. And so when we talk about wealth management here, there are a ton of different roles in our industry. And then within those different roles, there are, I think there's room for a lot of different types of people. So this is not a complete list, but in my mind, when I think about wealth management, you're really doing one of three things. You're either building your business, your client base, you're investing money for those clients, or you're servicing those clients. And this top line here, financial advisor, relationship manager, those tend to be senior team leaders. They're responsible for going out and identifying new prospective clients, introducing those clients to the firm, building and maintaining a relationship with that client. And then they're probably overseeing some aspect of the investing process. And then there's other team members that are responsible for servicing a lot of the day-to-day. But the whole wealth management firm is really organized around these three functional aspects of a wealth management business. So top here, financial advisor, relationship manager. The next one down, research. There are many different opportunities in research. If you are that analytical, maybe a little bit introverted person, you love doing analysis, you love data, you love reading, financial advisor, that may not be the right role. Research might be the better role for you. And you could be doing research on individual public companies. You could be doing research on funds. You could be working with a strategy team on setting asset allocation. You could be looking at direct investment opportunities. So many different opportunities to perform in an analytical role. The next is probably the largest opportunity in our industry because we're understaffed, and that's planning, financial planning, tax planning, estate, Monte Carlo analysis. For those of you who've taken investment or financial planning class, maybe we do a ton of Monte Carlo analysis to help our clients think about long-range planning, the building of their wealth, and then also the transition or transfer of their wealth from generation one to generation two. You can get a CFP. That's a really hot certification now. I think we have 10 or 11 CFPs at Summit Trail. So that's probably the easiest way to go out and get a really, I think, challenging and interesting job in our industry right now is financial planning. Trading, again, trading's getting less and less important, but there is still a fairly big trading business in our industry. Operations, administration, management, technology, these are all really important parts of a wealth management business and part of the wealth management industry. So, fintech, you think about a lot of these technology companies that are being built, going public, direct listing, SPACs, they're creating software and applications to serve the wealth management industry. That didn't really exist 20 years ago. And it's really been post 08, 09 where that's really ramped up. And so if you love technology and you're interviewing with a lot of companies, the financial services industry is a very, I think, well-paying industry for people with an interest in technology. So the point of this slide here is there are a very broad array of opportunities attracting many different types of people. And I have found over my time, primarily in the advisor role or in the management role, to really be rewarded by this function in this kind of sub-industry of wealth management. When we think about what we do and how we do it, Jim briefly mentioned on Open Summit Trail, we focus on ultra high net worth clients. We target $25 million net worths and above. Our average client's about 30 million. A big part of what we do is listening and asking questions that help clients share with us the right information. We take that information and start to construct long-term investment plans. We also start to put a financial plan together. And then there's sort of an ongoing process of staying close to the client, staying close to the markets, investing money, making adjustments, and really working in a team environment. So if you like teams, you like every day to be different, variety, you like to be close to the news, and that's not just capital markets, but all news sources have an impact on the market. You've got an opportunity here in wealth management. So there's a lot on this page, and we may come back to this at the end. But this is, I think, sort of a current snapshot of a typical day for a financial advisor. You could come in, whether you're going into your home office or you're going into the office as I was in today. Any one of these topics could be relevant or could come up on a call between you and a client. And you've got to be on top of this. And so I kind of divided into macro and micro, and those probably aren't the perfect definitions. But I think that we've got, on any given day, you've got macro things going on. COVID-19 has been a macro topic since last January, February. So we're going on 15, 16 months. Everybody's focused on earnings now and how are companies going to perform coming out of COVID. GDP, we have estimates right now for GDP is higher than what we've had dating back to the 70s and the 80s. Really exciting outlook on current GDP for the US and really many countries abroad. The labor force, unemployment, new jobs being created. I've got a couple slides on these topics. Rates, valuation, fiscal and monetary policy. You guys are all studying this. You know a lot about this. But on any given day, any one of these items could be impacting the overall markets. It could be impacting a portfolio or a position that one of your clients may hold. And you need to be on top of this. And we leverage a lot of research partners to help us keep track of and kind of stay current. On the right-hand side of the page, this is an interesting time. I can't remember over my last, 27, 28 years, so many kind of what I feel like are temporary investment-specific trends or issues or opportunities that have popped up. And I think we're all talking about cryptocurrency and Bitcoin right now, and that's a whole nother conversation. SPACs were really hot Every bank is working their analysts around the clock, and we're hearing about all those complaints and Peloton bikes and Goldman Sachs care kits being sent out because every bank is kind of overworked trying to get these SPACs public. ESG, really important, I think, for us as a country. And I think the younger you are, honestly, the more important ESG is. Cannabis has been around for a while, but with the new administration, there's going to be some more progress made there. ETFs have never been more concentrated. S&P 500 has 500 companies, but there's 5 companies that make up almost 20% of the S&P 500 ETF. A lot of risk with concentration. I think we're all familiar with GameStop, so Robinhood and Reddit Wall Street Bets. There's a whole kind of reemergence of retail investors. And with social media and that social network, they're having an absolute direct impact on the price of stocks and other financial securities. And as we saw with Wall Street Bets and GameStop, they're taking on some of the biggest, smartest hedge funds in the world and winning, and they won. So it's a really exciting time right now to be, I think, in this business. At the same time, it's very challenging. Growth versus value, large cap versus small cap, active versus passive. But this is a typical day where these types of topics are present, and we need to have a point of view. And so I'm not going to go into any more detail right now on these, but I'm more than happy for Q&A. If any of you would like to ask a question about any one of these or other related investment topics, I'm happy to cover them. So I wanted to spend a few minutes on current economics and our outlook. And so I've just pulled a few slides from our recent quarterly slide deck. And what we do at Summit Trail, if you think about wealth management, you have many responsibilities for your clients. There's a ton of research out there. We have a 9-person research team, which compared to a Merrill Lynch, B of A, or a Goldman Sachs, it's quite small. We allocate or really concentrate our research team focused on manager selection, going out and finding the most attractive value-added investment managers and strategies for each asset class. And then we pool that group of high conviction managers for each client on a customized basis. We build out an asset allocation with some bond managers and some equity managers and some hedge funds and private equity, et cetera. So we dedicated our 9 people to manager selection and portfolio construction. So what we don't do at Summit Trail is we don't do the macro, economics, interest rates, currencies. We spend hundreds of thousands of dollars with outside research firms who have much larger research teams, many more analysts. So we outsource macro research, and then we also outsource company-specific research. So if we have a client who had a venture capital investment and that company, let's just say it was Palantir. Palantir goes public in a direct listing. Now they've got this public concentrated position, and they ask us, what do we do with our Palantir? We don't have the research team at Summit Trail to really do true company analysis. So what we're doing there is we're really working with all the sell side firms. So we get access to research from most of the sell side firms. So, Merrill, B of A, Morgan Stanley, JP Morgan, Credit Suisse, Goldman. So we can go out and read multiple firms' research and start to build a point of view. And then we share that with the client and we make a recommendation. So these first couple slides are really kind of macroeconomic. And we're sharing this. This is a standard slide deck that we would walk our clients through. And again, one of my favorite parts of my role as a financial advisor is education. a lot of our clients did not create their wealth, they did not make their money or build their business in the financial services industry, manufacturing, technology, travel, gaming. So they're experts in a different industry, but they're very smart, they're very driven, they're very successful. They want to know about wealth management, asset management, investment strategy. That becomes their new hobby. And so we play a pretty significant role in educating our clients. Also, Gen 1 to Gen 2. Mom or dad made the money in the family. They sell the business. They now have a pretty big investment portfolio, but now they're worried about their kids. Their kids are 8, 10, and 12, or 20, 22, and 24, or 40, 45, and 50. Depending on the kids, depending on the parents. There's a whole process about how to communicate with your clients about how much money the family has. You may or may not want your kids to understand how much money is there. You may want them to get money early or get money later on. But educating a full client, meaning the whole family, is a really important part of what we do. And it's one of the things I really do enjoy. So here's a slide talking about COVID-19. You can see upper right-hand corner, here are cases. We had that horrible, kind of spike after the election, kind of building through February. We've come down nicely. Lower right corner, deaths kind of following cases. So COVID-19, I think single-handedly is probably one of the most important events that we have to continue to track, because it's going to impact everything else directly. So the good news is vaccinations. Despite the setback with J&J, we've got a ton of vaccines in this country. We're going to be back, I think, dosing J&J end of this week. I think we probably get the announcement, or certainly next week. But we're already, as you can see, lower right-hand corner, we're approaching 30% of our population. You can see that 18.8%, which is a slightly dated stat. Chile's at 20, Israel kind of leading the world. They're now over, I think, 65% with current data. So while you may have one view or another on Trump and how he handled the virus and that whole process, Project Warp Speed was a big success. And we now have, multiple vaccine providers, with a few more probably coming online. And the U.S. is about to kind of set the standard in vaccinations, even though it certainly didn't start that way. But vaccines is going to get us to herd immunity. And with herd immunity, we're really going to return to a almost, if not completely, normal life again. As we work the last bullet point here, we're starting to look at kids and safety there. So vaccines are going to be a big driver of our return to quote unquote normal, and what is really driving this just incredibly aggressive GDP forecast. With vaccines, with herd immunity, people are going to get out of the house, they're going to go back to work. Companies are hiring. Companies are struggling right now to find good people. People don't feel safe commuting. They don't want to go back to the office yet. They don't want to commute on public transportation. They like their unemployment benefits. Lots of things going on. But in order for us to kind of get back to GDP, we're going to have to get the labor force participation rate back up. And you can see what happened in this upper right-hand corner. Lower right-hand corner, we're printing jobs again after last April. And we should, and we do expect to see pretty significant increases in jobs across most industry groups. And again, with vaccines, leisure and hospitality just started printing big numbers, bars, restaurants, as well as private education. Stimulus is a big one. So we've never had, lower right-hand corner, you can see the personal savings rate. We've cut big checks to a lot of people. And when we're locked in, we can't go out for COVID that money goes in your checking account, in your savings account, you're saving it. So look at that spike in savings rate. It came down fairly rapidly, and it's going to continue to sort of drive down. And that money is going to come back into the economy. You look at the upper right-hand corner, it's almost 6 trillion of combined stimulus packages. We've never had that type of stimulus in this country before. And there's parts of the first stimulus package that still haven't been kind of put into the economy. So there is concern held by many that we've overstimulated the economy. And while I think everybody's focused on getting the economy back up, there are many people worried about the stimulation. There's a lag effect. You put capital in, the velocity of money is back up, and we're going to see that with inflation, higher prices. It'll be more jobs. It'll be higher GDP. But there is a concern that we've overstimulated, and we're going to find out, later this year and into 22. Upper right-hand corner has been a problem. I mean, wage really, kind of disinflation. Look at that trend. The call for a national, higher minimum wage is going to help address some of that. You can see in the chart there kind of the quick spike back up, but we've got a lot of people making a wage that people would describe as not a living wage, and we need to address that. And I think there's a lot of ways to do that. But the whole argument around inflation, right? You're seeing it in prices. I had brunch Sunday morning, and there was a $6.75 charge on my bill. We had 5 of us out for brunch, and it was a COVID charge. Gasoline has spiked because of oil. If you're buying products, there are price increases because manufacturers are incurring a variety of safety expenditures to protect their employees. And so we're going to see some price inflation. We need to see wage inflation to really get true inflation. I think most people believe we're going to have to see that with inflation on the wage side. So the Fed chairman, Powell, he's been fairly clear and relatively outspoken, low rates for a long time. Yet the 10-year Treasury went from 75 basis points to, I think, 175 in less than 6 months. We've pulled back a little bit. That sort of feels like inflation. It feels like inflation to a lot of people, and that caused the equity market to pull back a little bit. So a lot of questions about stimulus. Have we overstimulated the economy? What I'm most impressed by, and I'm not a big fan of Washington, what we learned in 08, Jim Murley and I were both at Lehman Brothers when we went bankrupt. We lived through that. Lots of stories to tell there. But the government didn't know how to deal with that type of financial crisis. No government in the world knew how to deal with that crisis. We figured it out. It took too long. And I think one of the criticisms was we did too little too slowly. We finally got there. And I give our government a ton of credit here. They didn't fool around. They came at this thing full speed. Both Trump and Biden. And so I think we as a country, and I think the Fed and Washington, I think they're comfortable overdoing it to make sure that we get out of this recession, which we've clearly done. And then we'll deal with some inflation on the back end. But I think there's a fair amount of concern about overstimulation. The reopening, this is what everybody's watching for. So you can see consumer confidence in the upper right-hand corner has really turned in late January into February, which is a great sign. Foot traffic, lower right-hand corner, we're basically back to where we were pre-COVID. Not in Manhattan. I was there today. And I think we're still running at probably 20 or 25. I don't think we're at 30% of pedestrian foot traffic, certainly in Midtown. I think downtown and uptown, the residential neighborhoods are feeling pretty good again. But lots of indicators to monitor here. Everybody's looking for a full reopening. And then they're kind of timing their bets on investments, CapEx, et cetera. These leading indicators are incredibly strong. PMI at 65, non-manufacturing PMI, it's 60, I think 63. You can see my second bullet point here. March 2021 reading was the highest since December of '83. This is really good. This is what's going to get us out. This is the recovery. Rates, again, inflation. Most companies are borrowing money off the 10-year. All of us who own homes are financing with mortgages based on the 10-year. So everybody's watching the 10-year. I think keeping the 10-year, whether it's 1.5 or 2, I think it's business as normal. I think there are a lot of smart people who worry about a 10-year treasury getting north of 2.5%. There's going to have to be a lot of good things going on with the economy to get there. And again, I think Powell's been pretty clear. He's going to do whatever he can to keep rates relatively low to give everybody a chance to, finance purchases, finance investments, finance a home purchase, refinance, et cetera. All right, I wanted to go back here. And again, I went through a lot of that really quickly. I wanted to get through it all. I want to go back to wealth management for a moment and just tell my Summit Trail story since I got through that quickly enough. And then I think we're going to open it up to questions in just a few minutes. So my background, I came out of business school. I took the job at Morgan Stanley. My classmates gave me a hard time. I was actually making less money there than I was at IBM before business school. $55,000 was my starting salary, and that was 1993. Joked that I was a stockbroker, I learned pretty quickly. I loved Morgan Stanley, great culture. I learned the business. I was relatively successful in building a business of wealthy clients. And then Dean Witter came in 1997 and bought Morgan Stanley. And we were, over a 3-year period, merged into Dean Witter, which was a much more retail-focused firm. It wasn't a good fit for our clients. We left and we took our team, we went to Lehman Brothers, had 5 great years at Lehman. I spent my time in management. I was running the wealth management business in 2008 when we went bankrupt. Very, very painful experience. We were bought out kind of last minute by Barclays, spent a couple years integrating our business into theirs, and then got really kind of tired. I wasn't a good fit for British banking culture. I just went back to being a financial advisor. And I went and just started to rebuild my client business. 2013, 2014, started to realize that Barclays was backing away from our business and starting to struggle with our client base and our ability to serve our client base. And so a few colleagues and I did some research 2013, 14, and we launched Summit Trail in 2015. And registered investment advisors, there are 18,000 registered RIAs with the SEC. We're one of the largest 200 in the country now. We built Summit Trail around our ultra high net worth client. The larger the client, the more complex they are, the more demanding they are, the more sophisticated they are. You can't put wealthy clients into models and into standardized products and give them standardized advice. It's all customized. And the one takeaway from the 2008 financial crisis that we all lived through was there was a regulatory response to protect retail clients. And so our industry went through a dramatic compliance build out. And while we lost a lot of really smart product and research people, every one of those that left, we'd hire 2 attorneys. And all of a sudden, I feel like we were being over-regulated and we were not able to do custom work and really give our clients the advice and service that they deserved. So we launched Summit Trail. to really focus on ultra high net worth clients. And this RIA business, this business model is it's built around the fiduciary responsibilities, where everything you do, you have to put your client first. The products, the fees, the advice, the research, everything you do, client comes first. It's a great business model. We have a great relationship with our two regulators, the SEC and FINRA. And we have found in 5.5, it'll be 6 years in July, that I think we're doing our best work in serving our clients because we're able to work very closely with them. We're able to really do truly customized analysis. We can use, and we've created sort of almost a market where for every client, when they need a service, we're kind of putting firms into competition. So I think one of the questions is, why would you leave a Morgan Stanley or a Barclays, a big bank, and go start your own firm? First of all, the trend, forget about Summit Trail. Advisors, clients, and assets are all leaving the big firms, and they're coming into this RIA channel. If we had 2 more hours and maybe a beer, I could put up another 20 slides and show you that trend. The bigger firms, they're great firms, but they are required to really manage to and regulate down to the least common denominator. And that creates a fairly difficult environment if you're going to try to do customized work. So looking back, I've had a great career in the industry, working with people like Jim. I really benefited from great culture at Morgan Stanley and Lehman. And even Barclays had a lot of good aspects of its culture. I just wasn't a perfect fit there. But I would encourage all of you to give financial services a strong and deep consideration. Don't put too much pressure on your first job. I always tell people, find a great company in a good industry. You don't want to get with a bad company. You don't want to get into an industry that's shrinking. Energy. I'm not sure I'm going to work for an oil company right now. Financial services has one thing that I think is really important for, I think, ever. It's money. Whether you're an institution, a government, or a private individual, we all work hard to make money, to save money, to invest money, to manage money, to live the life that we want to live, to leave the legacy that we want to leave behind, and to benefit others around us. I don't know how money would ever go out of style. And so I think you have an industry that's going to be here for the long term. So a lot of great companies, and as I've laid out here on this slide, so many different opportunities for all of you to kind of plug into this group. So I think I'll pause there at 6:45, and I'll turn it over, I think, to Dr. Strauss.
Okay, Jack, can you hear me?
Just fine.
Okay, thank you so much. And a couple of thoughts come to mind listening to you before we ask a number of the questions that have come in. Just for the students, I think it's remarkably important to hear from an individual like you. You could give, I think, a lecture on resiliency. Just to focus on what was said here. He was part of a firm that went bankrupt in 2008. Lehman Brothers went bankrupt. And this individual, Jack Peterson, is a senior executive in that firm. And I don't want to talk about what that felt like. We can imagine. Now it's 15 years later, and somehow you're on top of the world. So there's some personal characteristics that maybe we can touch on here, but I'm sure it's a remarkable story of resiliency and not allowing failure to really to set you back. That's one of the takeaways. I want to ask you about the RIA model, though, first. And that is, you said you started in 2015. 6 years ago, you built an enormously successful firm. RIAs get paid, compensated differently. How do you think about the compensation that your firm receives from your clients? and that mechanism contributing to the success of the firm, the alignment that takes place compared to how the other firms are paid?
Yeah, Dr. Strauss, great question. And again, it comes back to that fiduciary requirement. We are truly fiduciaries. A challenge for our industry, in particular, I'm talking about the retail industry. It is fees and other forms of compensation. And if you look at this slide that's up, asset management, there's a lot of products and firms over there that are building products that have fees kind of embedded throughout it. And they're not necessarily easy to identify. The RIA model and our responsibility as fiduciary is to be very transparent with our fee structure. There are different ways to charge clients other than performance fees, which the SEC is still not comfortable with. For most of our clients, we're charging an advisory fee, basis points on the assets that we're managing. And that might be 100 basis points, for a smaller client, and it might be 25 basis points, for a very significant family office and everything in between. And that fee is really set based on the assets and the complexity, kind of scope and scale of the mandate. Some clients are paying a flat fee, maybe in addition to or instead of the basis point fee. What our RIA channel does not do is we do not charge commissions on any sort of trading. And most RIAs are also not getting paid by any product manufacturer. Summit Trail receives no payments by anybody except for our clients. And we have a fee sheet and it's fully disclosed. And so we have complete fee transparency. But back at my day at Morgan Stanley or Lehman or Barclays, any US bank or broker dealer, they can be using, the easy ones to pick on are structured notes, where you've got a client that they've got a 20% upside and 5% downside on the S&P, no risk, but there's a 4, 5, 6% sales credit kind of built into the combination of derivatives used to create that contract. Mutual funds have 12B1 fees. There's an institutional class with no 12B1 fees, and there's a retail class with 12B1 fees. If we're using a mutual fund, which we do in a couple asset classes, we're in the institutional share class. We never accept a 12B1 fee from the company. Morgan Stanley, Merrill Lynch, they charge shelf space. If a manager wants to sit on the Morgan Stanley platform, that long only or hedge fund manager is going to have to pay a fee to be accessible to the 20,000 advisors at Morgan Stanley. Now, that doesn't make that advisor Morgan Stanley a bad person or a bad professional. What it does is it creates a conflict of interest. And as a fiduciary, and what the RIA is really built around is identifying what those conflicts of interest are, rooting them out, and trying to avoid them either in policy or in transparency. And I think we do a really good job of that at Summit Trail. And I think many of our peers in the industry do the same thing.
Thank you. I've got a couple of questions from students thinking about getting into the business. So I'll just read you this one from a student that says, I have a large interest in wealth management for a few semesters now. I've been researching it a lot, and it seems like a career I can do well. I've been getting discouraged lately because many listings for wealth management and financial advising on LinkedIn or job posting sites end up being cold calling positions, dropping a list of 200 people I know that would be willing to invest in products I'm told to push. How is Summit different? And is all of entry-level wealth management cold calling and sales? This has really brought down my morale and view of wealth management.
Yeah, so you're bringing me back to 1993 where I was cold calling. So, I mean, that is part of the industry, you know, and it goes back to my one slide here, you know, wealth management roles up top, you know, building, investing, or servicing. So if you want to be a financial advisor, I think what used to be a fairly well-established standard was most firms had a 2-year training program. And yeah, you were cold calling. You have to find clients. But you had a couple years to do it. And I think post 08, everybody cut back and, you know, margins were compressed. And so I don't think that same kind of multi-year training program opportunity exists as broadly as it used to. And so a couple of thoughts. I think if you want to start off as an advisor on day one, you're going to have to come up with a plan to get clients. Now, there are firms, many firms, especially in the RIA channel, that don't necessarily require you to have your own clients or build your own book of clients. You're going to start on a team as an analyst or an associate. You're going to be learning the business kind of ground up. And in some ways, it may feel like a bit of a step back. You certainly don't need an MBA to perform that job. However, competing with other peers that don't have an MBA and it gets you the job with your past experience and your education now, you're going to be able to, you know, accelerate more quickly, come up the curve faster, and you will graduate through a couple of roles into the advisor role where the firm is asking you to take on clients that are coming into the firm. Summit Trail, we're now, after 5.5 years, starting to get some inbound phone calls. You know, we had no brand 5 years ago. We still, relative to the big firms, we have no brand. But the way we grow our business, and this is something you should think about, we don't cold call. We don't advertise. Again, we're trying to get to very wealthy individuals. 2/3 of our clients are private business owners, some public business owners, but they're entrepreneurs. They're first generation wealth. And so we're networking with attorneys, accountants, business managers, sports agents. And by building that network, establishing those relationships, helping them maybe with their clients, over time, they'll start to refer your clients in. So there's a couple, and this is a much longer conversation, happy to take it offline, but you should look beyond the traditional Morgan Stanleys and JP Morgans of the world. Although JP Morgan on the private banking side is a little bit different. But I would look at the RIA channel. I would look at trust companies, a Bessemer Trust. I would look at the private banks. The broker dealers are the ones that are going to say, here's the phone book, you know, go do it. And it's tougher to do it. I don't think I could build a book cold calling today that I built in 93 and rebuilt in 2011. So I relate to you. Happy to kind of connect offline on that one.
We had a couple of questions like that. Switching gears, a couple more questions. What are your thoughts on cryptocurrency?
Yeah, so crypto, I think a lot of smart people missed it. And I think even our CIO, who I give a hard time to occasionally, he's a very conservative guy. He's 12 times smarter than I am. But really, really smart people struggle with things like crypto because there's no way to value crypto. Bitcoin, Ethereum, my favorite, Dogecoin, right? It's hard. There is no metric. It's truly eye of the beholder. But I had this discussion the other day. It's no different than gold. People say, you know, gold is different than crypto. It really isn't. There's a ton of gold out there. If gold goes up in price, we're going to go mine a lot more gold. If gold goes down in price, they're going to stop mining. It's kind of like oil, except oil is actually consumed. Petroleum is a product, an input for manufacturing, transportation, et cetera. Gold, Jewelry, yeah, not really. So I don't look at Bitcoin really that much different than gold. For the time being, and as long as it is, it's a store of value. It's not a currency. I think again, just my opinion here, a lot more smarter people, much more experienced than I am to talk about crypto. I don't think of it as a currency. A currency has to be readily exchanged for barter. We're not there yet. It could turn into that. I think what it is right now, it temporarily at least, it's a really good and highly speculative store of value. It could go up 10x and it could go back to something really, really small. It is definitely not for the faint at heart. It's not going away. I don't think it's going away. When you have Paul Tudor Jones putting a couple % of his multi-billion-dollar balance sheet into it, you've got corporations, you've got institutions, Goldman, JP Morgan have trading desks. It's not going away. I don't know where it's going to go, but it's not going to go away. So I find it fascinating. I do a lot of reading on my own time. It's pretty cool.
Thanks. Maybe we have time for two more. That first one, early on when you were talking about the industry, you mentioned, and somebody brought up here, that trading has become less important. Can you just talk about that, expand on that, why trading has become less important?
Yeah, so I think the typical trader worked at Goldman Sachs or Morgan Stanley or one of the big bulge bracket firms. And, she came in the morning at 6:30 or 7, and she had her book that she was trading, and she did well throughout the day. She made a profit. She went home feeling great. She came back in the next 5 days a week, 220 some odd days a year. At the end of the year, they gave her a bonus, a percentage of what she made for the firm. There was prop trading, and then there was client trading. Dodd-Frank has basically eliminated prop trading. So banks, for the most part, really can't trade their own book. A few exceptions. So now you're down to client trading, and it's all going electronic. So when I talk about getting into a good industry, a growth industry, as opposed to maybe a mature industry that may be starting to stabilize or maybe shrink, trading is one aspect of financial services as a whole that is shrinking. There are fewer and fewer people in trading every year, and for one reason: quant, computers, algorithms, models. So computers are being used very effectively. They're better than humans. They see things faster. They identify patterns. They can enter orders more quickly. They can respond to data more quickly. So, one by one, traders are getting retired off the desk. And I would be telling my own kids, we're not doing trading. I'm not saying you can't go out and get a job. I'm not saying you can't go make a ton of money, but you're picking a fairly narrow role in a massive industry, and it's a role that is actually shrinking, and it is being replaced by technology.
One quick last question, maybe quick answer because we're running out of time. Have the retail investing platforms that do not charge any commissions affected your business at all?
I think not really, but they will. We've talked about fee compression all the time. We're going to have to stay competitive with our fees. I think what the robos started 10, 12 years ago, and we had an exercise, every partner at Summit Trail had to sign up for one robo account just to get look and feel. Robos have great technology. That was the original kind of online, kind of digital model. Robinhood, very, very different. Now they're selling their trade so that they're getting paid for their flow. That's not as bad as it's been made out to seem by mainstream media. But Robinhood has brought this social network and sort of social media component or element, which is very different. You have a lot of people investing and or I think risking money, gambling for the sport, not for the valuation, not for the long term, but for the short term. Nothing wrong with it, but it's a very different market force, and it's causing problems. It's getting in the way of common sense and traditional valuation, fundamental based analytical tools. It's not going to go away. They may overregulate it and try to, kind of squeeze it out, but I think it's good. Innovation in any industry is good. If you're good, you got to stay on top of it. You got to continue to innovate. So I don't think they're a direct threat of ours, but it's a good force, and we have to address it.
Well, I'll speak for myself, and then I think Nicole's coming in. Jack, pleasure listening to you and having the chance to ask questions that students have submitted, and continued success in the firm. It's a great story. And hopefully some of our students someday will graduate and qualify to become your client. That's what they're all trying to do. So that's the goal. Nicole, are you coming back in?
Yes, I am. I'm here. Thank you. Thank you very much. Really, that was an amazing presentation. I think we are actually all a lot smarter now than we were probably about 1 hour ago. Really, I think just it was really amazing just to hear about, the current investment topics, your assessment of the economic outlook, the market outlook. Overall, I think this was a really nice presentation. We really enjoyed learning about your career path, and most of all, just the general career advice. I think this is always something as students and future business leaders, it's always important to hear from successful people. So again, thank you so much. And we really do appreciate you joining us. If you will indulge me a moment, Roger, if we could put up our slide, I'd like to just do a quick shout out for our next presentation, which is going to be on right there. We got it. I believe it's on June 3rd. This is Aurora Castrier, who is a partner at Troutman Pepper. And she's actually a really impressive attorney. And she's going to talk to us about a lot of the ethical issues related to artificial intelligence, and just, prepping for her presentation has been really eye-opening for many of us. So please look out to join us. And then, of course, we are working on an impressive lineup for the fall. So we really do appreciate that you joined us. For those people who are going to be graduating in the next few months, we want to wish you best of luck, and we would love you to come and rejoin us again once you are an alumni. So don't think that this means this is your last opportunity to join us. So thank you again, everyone. Thank you, of course, to Jack. Thank you to Ron and to Jim for helping us out this evening. And we wish you all best of luck finishing out your semester, and go out and enjoy the nice weather. So have a great evening.